Recently, it has been 8 years since I started investing, and in this video, I want to share with you what I have learned during that time. Personally, I was fortunate to have been taught financial literacy from a young age, so I knew very well that the earlier I start, the better. I started investing at the age of 18, and that is the first advice I would give to my 18-year-old self. Start as soon as possible. It doesn't matter how much money you invest, you can even invest $50 per month. The most important thing is simply to start as soon as possible, and I have two main reasons why. The first reason is compound interest, where time works in our favor, and all we have to do is take advantage of it. Compound interest works like a snowball and has two variables that work in your favor. The first is time, and the second is return. The larger these variables are, the greater the effect of compound interest. Our goal should therefore be to maximize both time and return. From my experience, it is much easier to maximize time than to achieve a 1% higher return. Nowadays, most brokers offer demo accounts. You can find links to them in the video description. On these demo accounts, you can try investing without any risk. It might help you get started. The second reason why it is crucial to start investing as soon as possible is that at the beginning, you will simply make mistakes. Everyone makes mistakes, and you will make them too. It's normal, and it's important to learn from these mistakes. It's also great when we make these mistakes while investing $50 instead of making them later when we invest millions. Most of us didn't have millions in our accounts at the age of 18, so it's the ideal time to try investing and make those mistakes right at the beginning when it doesn't cost you as much money. When I started investing, I made a lot of mistakes from which I gradually learned and improved. For example, the first mistake was buying stocks without actually knowing how to analyze a company. However, there was one thing I did right, and that was considering buying stocks as buying a piece of a company. Stocks are not just lottery tickets. Behind each stock, there is a company, so essentially, I was buying businesses that I believed would be of high quality. This meant buying large technology stocks, Pepsi, McDonald's, and other well-known brands. The problem was that I couldn't interpret their financial results, which is crucial when investing in individual companies. You can buy virtually any stock, but whether it was a successful investment largely depends on the price at which you bought that stock. It's the same in normal life, where if I wanted to sell you a car, your first question should be, for how much? If I buy a new Audi for $500, I probably made a pretty good deal, but if I buy the same car for $1 million, I probably paid too much. The same principle applies to stocks, and here we come to a point that really began to change the way I invest. I first read several books on how to interpret financial statements of companies. Thanks to that, I was able to read financial statements and, for example, see how much debt a company has, whether the amount of unsold products is growing, or how much they overpaid for acquisitions. These are all aspects you want to look at before buying stocks. Learning to interpret financial results and not relying solely on simple metrics like price-to-earnings ratio or price-to-sales ratio or price-to-book value ratio was very helpful. It helped me understand how businesses operate. Companies often use various accounting tricks, and ratios like P/E or P/B can be distorted. So another advice I would give to my 18-year-old self is to learn how to interpret financial statements as soon as possible and understand what they mean. At that time, I was still relatively new to this, and I was buying companies without considering their intrinsic value. I was essentially investing blindly. I was mainly doing qualitative analysis, looking at the company itself and evaluating its quality. However, I didn't pay much attention to the numbers and the value of the company at the time of purchase. Maybe you're in a similar position now, where you buy a company just because it pays dividends. Don't get me wrong, I also like holding dividends, but analyzing a company is much more than just tracking the dividends it pays. Fortunately, I realized this mistake relatively early on, so I started reading books about investing and listening to interviews with legendary investors. And they can help practically anyone. However, I was still making absolute foolishness at that time, such as selling stocks because I was afraid of market downturns. Now I know very well that no one can consistently predict market downturns, and when you invest in stocks, there's always something to fear. In 2018, I experienced a significant market downturn. At that time, I owned quite a few technology stocks, and most of them lost around 30%. Luckily, I wasn't foolish enough to sell them at that time. However, I still didn't know what was happening and why prices were falling so much. And I have to say, I didn't feel completely comfortable. After all, it was the first time I lost so much money so quickly. And I think this is quite common, especially among novice investors. When you see that your portfolio suddenly loses around 20% of its value, especially if you don't understand some of the reasons why those stocks are going down and you're unable to calculate the real value of the stock. Nowadays, when my portfolio loses, let's say, 20% of its value and I potentially lose millions of dollars, it doesn't bother me at all. Instead, I focus more on the companies I can buy now. And to a large extent, I even enjoy the fact that I can purchase these companies at a discounted price. I believe this is a huge change compared to the beginner I undoubtedly was 6 or 7 years ago. Even Warren Buffett says that the stock market is the only place where people run away when things are on sale. Basically, people's psychology works in such a way that when stocks go down, we want to sell to avoid further losses. We're simply afraid of more decline and so on. However, during those times, we should do the exact opposite if we have a long-term investment horizon. We have time to wait for the markets to return to normal, and we can take advantage of market declines. This brings me to another point, which I believe I've been relatively good at from the beginning. Sometimes you just have to praise yourself when no one else will. I've been investing with a long-term perspective since the beginning, and I haven't tried to get rich quickly. Quick wealth is often very tempting for beginners, and from my experience, I can tell you that you won't get rich quickly through investing. There's simply no real way to get rich quickly through trading. And anyone who claims they can is, in my opinion, lying. So why do I think so differently about market declines nowadays and rather look forward to them than fear them? The problem back then was that I wasn't able to calculate the value of a company. Essentially, I just held stocks without knowing their true value. That changed as I gradually read books and listened to Warren Buffett, Charlie Munger, Howard Marks, and even Peter Lynch. Very soon, I realized that value investing is the only intelligent approach to investing. Why? Value investing involves buying stocks below their intrinsic value. You can think of it like waiting for a sale in a store and buying things when they're cheaper. Actually, it works the same way outside of stocks as well. In any transaction in life, what you receive is the value, and what you give is the price. For example, when you work, the price you pay is your time, and the value you receive is logically your paycheck, but also skills, experience, or connections. Value may not be so obvious, and I believe many people would only mention the paycheck. The same principle applies to stocks. The price you pay is logically your purchase price, and the value you receive is a share of the future profits of the company you're buying. So, for instance, if you buy 1% of McDonald's shares, you're entitled to 1% of all future profits of McDonald's. Value investing essentially means buying a company when today's value of future profits is greater than today's price. So now, you just need to determine how much you're willing to pay for 1% of all future free cash flows of McDonald's. And you do this by trying to estimate the present value of these future cash flows. This estimation will then represent the true value of 1% of McDonald's. How do we calculate the value of a company then? The basis is usually the so-called DCF analysis, and essentially, this analysis can be done in several steps. Step number 1. Estimate the company's future free cash flows. Essentially, you're trying to estimate the company's growth in the coming years. And to make this estimation, you really need to know the company and understand how its business operates. Step number 2. Discount these future cash flows to their present value. Money in the future has less value than money today. Why? Because you can invest money today and earn a return on that money. That means you'll have more money in the future. For example, if I invest $100 today in government bonds with a 5% annual return, I would have $105 after a year. In other words, $105 a year from now has the same value to me as $100 today. Assuming I have a safe investment with a 5% annual return, it doesn't matter to me whether I receive $100 today or $105 in a year. So in this step, we take the company's future cash flows and try to discount them back to their present value. Step number 3. Sum everything up, and we have the present value of the entire company. Now, we just need to divide this present value of the company by the number of shares, and we have the result. All the numbers you need for calculating the shares are publicly available and can be found in the so-called 10K reports, which are essentially annual reports. You can always find links to these annual reports on the company's website, which should have a subsection called Investor Relations. Being able to estimate the value of a stock was very helpful for me. For example, when there was a significant market decline in 2019, I was able to calculate the real value of those stocks and buy them. However, one of the mistakes I made before was not investing that money into a passive ETF that tracks the S&P 500 index or maybe into Berkshire Hathaway stocks. Essentially, before I was able to calculate the value of a stock, I was just shooting in the dark. And if I could go back, I would advise my 18-year-old self to invest first in passive ETFs that track the S&P 500 index or in Berkshire Hathaway stocks. And only after learning how to invest, I would start selecting individual stocks. If I were 18 again and a complete beginner, I would do it by investing 90% of my money in Berkshire Hathaway stocks and keeping 10% to select individual stocks. Selecting individual companies and conducting their analysis is not easy, so by investing 10% in individual stocks, I would continue to educate myself. I would remember those mistakes much better because they would result in real money loss. On the other hand, I would have 90% in those stable stocks or ETFs, which would serve as the foundation of my portfolio. Another important thing I've learned is that you have to keep learning. It doesn't work that you read a few books, and suddenly you know how to invest. With some books, I understood certain points only after the third reading or when I actually invested real money and experienced it firsthand. Another mistake I made was investing outside of my competence zone, in other words, investing in companies in an industry I didn't fully understand. Even Warren Buffett himself mentions that as investors, we have a huge advantage. We don't have to rush. If we don't buy stocks today, tomorrow Mr. Market will come with a new offer, and we can keep rejecting it until a truly interesting opportunity comes along. It's easy to say but harder to execute. However, it is one of the fundamental rules I've learned. If I don't understand a company and its industry well, I shouldn't invest in that company. If I truly don't understand a particular industry, how will I know if there's a new competitor in the market with a better product? While it's nice to be able to estimate a company's future cash flows, what good is it if the estimate is incorrect? Essentially, your entire company analysis relies on how well you understand that company. If you don't understand the company well, your analysis is based on weak foundations. Consequently, the estimated value of the stock you're assessing may be completely off. It was at this point that I realized how detailed my knowledge of a company had to be in order to estimate its real value. Of course, even when you know the company well, you can never estimate its value completely accurately, and that's where the concept of margin of safety comes in, which is a concept from Benjamin Graham's book, The Intelligent Investor. It's a very simple but crucial concept. We want the value of the stock to be several times higher than its price. The margin of safety is simply the difference between value and price. And we only want to buy stocks when the margin of safety is sufficiently large. The margin of safety essentially protects us from our errors in estimating the company's value. In practice, you quickly realize that estimating a company's future cash flows is not an easy task at all. And the margin of safety precisely protects us from errors in these estimates. As I continued to invest and gain more experience, I discovered that finding undervalued quality companies is not an easy task at all, especially if they are well-known companies. In these cases, practically everyone knows that they are very high-quality companies. Therefore, buying them at a good price is quite challenging. For example, Coca-Cola or McDonald's, everyone knows these companies and knows that they are high-quality companies with a proven business model. This generates interest in these stocks, which are then traded at a relatively high valuation. Simply don't expect to go through a few companies and immediately find super investments. Nowadays, I can go through hundreds of companies and still not find anything among them. That's another thing I've learned. When investing, you must be patient. You must know why you're buying a company and have the patience to wait when the company is trading at a price that is too high. When investing, we have no need to rush. I know that in the beginning, I also felt FOMO and similar things. For those of you who don't know, FOMO stands for fear of missing out. In other words, you're afraid of missing out on an opportunity. Today, I know that there's no need to rush when investing because Mr. Market will come with a new offer behind you the next day. And to conclude this video, I would also like to say that there is still a lot I don't know. But what I do know very well is that people who go on television and predict where the markets will be in the next 6 months also don't know a lot. I quickly learned to ignore these market predictions and not give them any weight whatsoever. No one knows with 100% certainty whether the markets will fall or how the stock market will perform in the following year. Therefore, in my opinion, it's not worth focusing on these things. So, a quick summary of what I've actually learned. Firstly, you need to start as soon as possible, both because of mistakes and the power of compounding. You'll find links to brokers in the description if you haven't registered anywhere yet. Secondly, when you invest, you're buying a piece of a company, and you should also consider that. Thirdly, learn to read a company's financial statements before buying individual stocks. Fourthly, when you invest, you'll still have fears. Simply ignore those concerns. Fifthly, value investing is the only type of intelligent investing. Why would you want to buy something where the value is lower than the price you're paying? Sixthly, learn how to calculate the value of a stock, otherwise, you're essentially shooting in the dark. Seventhly, you still have to keep learning. Read those books even several times. Eighthly, Are you really 100% sure that you know the company you're investing in? Ninthly, buy only when you have sufficient margin of safety. And 10thly, be patient. The market will come with a new offer the next day anyway, so you have no need to rush. The main reason why I'm making this video is to show you that many people make mistakes. It's important to learn from them and move on. Personally, I think it's a shame that people don't openly discuss these mistakes and talk about them. Since you've watched until the end, here's a reward in the form of a puppy picture, and I genuinely want to thank you for watching until the end. I appreciate it a lot, and I hope to see you again in another video. Bye for now.